Retirees today face three very unique problems that prior generations just did not face. So we're going to talk about what those three unique problems are. Plus, we'll also give some tax tips for newbie investors. Maybe you're new to investing. Investing these days has gotten a lot more interest of late, and so many people may be surprised that what they're doing is going to have to be reported to the IRS. And so we'll go over some tax tips for those newbie investors. Welcome this Sunday morning to Dollars and Cents, where we help you make sense out of all of those different decisions that have anything and everything to do with your dollars. We're Central Florida's longest running radio program, coming to you this morning on the News Radio Orlando network, along with 96.9 The Game. I don't know about you, but I'm very excited that it is football finally. Particularly our listeners are 96.9 The Game. They must be very excited. What follows after our program is the Bucks pregame. Man, it's going to be an interesting season for the South Patriots this year. We're also one of the top 25 financial planning podcasts on the World Wide Web, with over 12,000 downloads of our podcast at last count. My name, Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready to help you this week create a successful financial plan that provides you with peace of mind for the future. So before we get to those other topics we talked about at the top of the program, we thought we would ask a question of our listening audience. And that is, are you an investor or are you a gambler? There's a pretty big difference between those two. There's also a pretty big difference in terms of how you approach investing, how you approach your finances, how you look at things. The reality is that more and more the data is suggesting that more people are being gamblers with their money when it comes to the financial markets rather than investors, right? Investors saving money, putting it away, doing it on a regular basis, and ultimately looking towards a specific goal that you're looking to achieve over time. That's a classic description of an investor. A gambler, meanwhile, is looking more for the short-term reward, quick fix type of an approach to solving their financial problems. And the problem is that the data suggests that gambling is very much on its rise, particularly when you look at one area of the market that has seen just an explosive growth in the amount of people that are using it. And what we're talking about is options trading. Options trading, the statistics on it, and we'll share those with you in just a minute, have really exploded the growth or the usage of options trading. And so what you have to understand is exactly what options trading is in the first place. And at its core, using an option allows you to accentuate the return in the market. Of course, the flip side of that is that it's also going to allow you to potentially accentuate the loss as well. But the reality is, let's start off with a description of what options are. So an option at its very core entitles you to buy something at a set price sometime between now and a future date. That's the core of it. You don't actually own the thing. You own the right to own that thing. So if you're using a call option, you've got the right to buy a particular stock, whatever that call option is written on for that particular company. So you've got the option to buy a share of that company at a certain price and ultimately within a certain period of time. Options always have time limits on them. And so if you're using a call option strategy, then you're using that because you think that the stock price of that underlying stock that you got the option on is ultimately going to rise, right? So that if the price rises and you've got the option to buy it at less of a price, then the reality is that you're able to make a profit. Meanwhile, a put option is sort of the flip of that, right? So a put option gives you the right to sell that particular company at the set price of that option within the set period of time of that particular option. So that obviously is going to pay off more if that stock falls. So if we use a very simple example, these rights, if you will, allow you to sort of not really own, because you don't own anything, you own the right to own, but they allow you to engage with the performance of a stock at a significantly reduced price. So let's use a simple example. Let's say that you're looking to buy a share of Apple. Well, Apple closed on Friday at $112 a share. You may not want to spend $112 just on one share of Apple, but if you look at the options on Apple, well, those only cost $3, because remember, an option is a right to buy or a right to sell, so you've got to pay somebody money to be able to have that right, because an option, after all, is a contract. So there's a person on one side of the equation that's sort of the buyer of that, and the person on the other side is the person that is selling that. So there has to be an exchange of money. Typically, that's the premium. So if you look at that Apple option, premium $3, it gives you the right to participate in a stock that's actually valued at 112. And obviously there are some stocks out there like a Tesla, although they just did recently do a stock split, but still $400 or $500 a share. Not sure you're going to want to pony up a whole lot of money to get a whole lot of shares. Options gives you an opportunity to buy to sort of own, or at least own, a share of the performance of that particular underlying company during the course of that particular time of which the option exists. Okay, so that's the background options. That's how option works. What's going on today? Well, what's going on today is the surge is really unbelievable, particularly when you look at smaller investors. And I'll give you some statistics here. So in late August, so that setting aside the past 2 weeks where you had a bit of market decline, the reality is that options have become very popular since March, because the market's been sort of going straight up since that low that it hit at the peak of all of the government lockdowns due to COVID. So in late August, there was a record 62% of premiums paid for options that were bets on rising stock prices coming from people who were buying no more than 10 contracts, which means effectively 10 shares. That is a small investor, because for the most part, you typically see options traded in denominations of 50 or above. And if you're buying 10 contracts, you're not really committing a whole lot one way or the other, right? I mean, 10 contracts, $3 a contract. For the premium, that's about $30. That's definitely a smaller investor. Typically, when you look at the amount of contracts that is bought and sold in the market, typically the purchase of 10 contracts or less accounts for about 34% of all options. You can see where in traditional times, 34% of options being bought would be 10 contracts or less, small investors. Now that number all the way up to 62%. So basically doubled, which means that there's a lot of money flowing into options these days among smaller investors, newer investors. The other perspective to think about is just the amount of dollars that people are spending on these options. So for the week ending September 4th, these small traders, people buying 10 contracts or less, spent $11.5 billion on option contracts. That is not just a record high, that is 9 times the amount that was spent based upon the average a year ago. That's how big the numbers are. Put it in perspective, last year in 2019, Americans spent $91 billion on lottery tickets in the entire year. 91 billion lottery tickets in the entire year. 1 week spending $11.5 billion on options. We got one word for that, and that is yikes, because that's pretty dramatic. Options trading is perhaps one of the most risky investment strategies, period. Stocks don't always go up, and they don't always go down. And the reality is that when you're using an option, you are in essence using leverage. You don't own the actual thing. That's what leverage means. You don't own the actual thing. Instead, you're using something that is related to it in order to participate in that thing that you don't own. And folks, we would submit to you that that is not investing. You don't own the thing that you're actually tied to. You own something similar to it, or a derivative really from it. And if you're owning that, that's more like gambling. That's not investing. So folks, make sure that you are an investor and not a gambler, because if you're a gambler, you may win. More often than not, you lose. And at the end of the day, what you're playing with is your future retirement, your future financial stability. Frankly, probably better off buying a lottery ticket. Anyway, don't play with fire. Don't be a gambler. Be an investor. Up next on the program, we will talk about some of the important tax considerations that new investors need to be aware of. All that and more coming up next on Dollars and Cents with your host, Joel Garris. News Radio WFLA Orlando, 96.9 The Game. New investors out there, make sure you understand what the tax implications of what it is that you're doing with your money, because there's definitely some tax issues that folks need to be aware about. And if you're new to investing, you may not be aware of some of the rules and tax issues that you need to be aware of. Welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars, coming to you here on Sunday mornings on the News Radio WFLA Orlando Network, along with 96.9 The Game. Coming up next, the Bucks pregame. Man, I'm very excited about the day. We're going to sit and we're going to watch the Patriots. And then after that, we'll watch the South Patriots. So that'll be a lot of fun. One of the top 25 financial planning podcasts on the World Wide Web is this program with over 12,000 downloads. My name, of course, Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you with a successful financial plan that provides you with peace of mind for the future. So lots of folks trading these days. We talked a little bit about that in the prior section. Hope you're not a gambler. Hope you're an investor, not a gambler. There's a big difference there. At Schwab alone this year, 1.6 million daily trades for the second quarter, more than double what that was a year ago. A year ago, number of daily trades, 716,000. So you got a lot more people trading. If we pull in Robinhood, one of the cool new apps out there that provides for trading on your phone, new accounts, 1.5 million new accounts at Robinhood in just the first 4 months of the year 2020. So what you have to realize is that there are some tax consequences to your investment strategy. As with anything in life, if you're doing it, the IRS wants to know, because if you make money at it, they want their cut. So here are some of the tax things that you need to consider when you're investing on these types of platforms. First of all, some basic stuff, tax 101, if you will. The good news when it comes to investing and how taxes and things like that go about, you don't have to pay Social Security tax or Medicare taxes when you have an investment profit. So that's great, right? Because that's a big part. If you think you've got your work income, that winds up to be about 7.5% of every dollar that you make working on the job, if you will, that has to go off and pay Social Security, Medicare. So that's good. The bad news is that there's no automatic withholding of income taxes when you do investing on an after-tax basis. And that's what a lot of these platforms, I think with Robinhood, all you can do is on an after-tax basis. I don't think they'll let you do it on IRAs or any type of retirement account. So you're definitely dealing with after-tax money, which means then that if you're buying or selling, particularly if you're at a gain, you've got to pay taxes on that, as opposed to your paycheck, where it gets withheld automatically. You've got to pay those taxes along the way. through the use of quarterly payments. So just be aware, Uncle Sam, always there, Tax 101, hey, they're going to want their slice of it. Number two is understand kind of what the gains and losses kind of thing looks like, right? So a gain is if I bought at 10 bucks a share and then sold at 12, then I've got a $2 gain. That, though, the taxation of it depends upon how long you hold it. Well, if you're not holding these stocks very long, which means less than a year, in essence, that gain is considered a short-term capital gain, and short-term capital gains are taxed at ordinary income tax brackets. And as it plays out, that gain, that short-term capital gain, will in fact be taxed at your highest marginal tax bracket, because that's new income. That's additional income on top of any of the other income that you're currently getting. So if you're not owning that stock or that investment for more than a year, well, then you're going to be paying at income tax rates, which are much, much higher than long-term rates. If you own something for more than a year, then you can sell it, and typically the biggest rate on capital gains, long-term capital gains, is 15%. So don't confuse the two. Many people think, oh, it's a capital gain, so it must be at that lower rate. The problem is, though, there's a distinction between long-term versus short-term. If it's short-term, it's going to be ordinary income, and ultimately you're going to have to pay taxes on it at that higher rate. Also understand that if you may have a bunch of losses, you're limited to what you can use on those losses. You can use your losses against your gain. That's not a problem. But if you have more losses than gains, then you're only limited to 3,000 of those losses against other income. So let's say you made 100 grand this year and you've got 20,000 of losses. The reality is you can't use the 20 to offset the 100. You can only use 3 of the 20. Now, you don't lose that extra 17 in that example. It just carries forward. But know that you are limited in terms of the amount that your losses is going to be able to be used against your other income. So in terms of taxes and trying to sort of figure out what's the best way to minimize taxes, one thing to be thinking about is which type of tax basis you're going to use. And one of the options that you've got is to be able to use something called share identification. And what that means is that you look at a particular share or a particular series of purchases, and if you sell certain of those shares, then you can say, sort of match up, if you will, well, these shares that I sold match to these other shares where the cost basis or the purchase price was much higher. So know that there are some options that you have in terms of share identification that may allow you to reduce down what the overall tax liability is on your gains. So just be aware of that. Next up to be aware of is this wash sale rule, right? So if you sell a company and ultimately you wind up having to have a loss on it, you can't go ahead and rebuy that company within the next 30 days. Otherwise, that loss will be disallowed because you're not allowed to do that. The IRS says no. So if you bought a stock at 10 bucks a share, it's now at 8, you sell it. 2 weeks later, you're like, oh, well, wait a minute, that's, the company looks great now, I'm going to go back in and buy that. Your loss will be disallowed. You will not be able to take it. You'll have to revert back to the original basis based upon that subsequent purchase. So just be aware of how the wash sale rules work, and ultimately know that there's a 30-day period where if you sold at a loss, you can't go back in and buy that same stock. Other things to consider when you are an investor or new to investing these days is that there are some other taxes that kick into play beyond just whether you've got capital gain, long-term gain, short-term gain, dividends, or interest, but there is, of course, the investment surtax, which is 3.8%. That actually kicks in for a married couple at income above $250,000 or a single person income above $200,000. You just be aware that if you and your wife are working your jobs and you've got a decent level of income and you've got this investing stuff that you're doing on the side on top of that, understand that there may be an additional 3.8% surtax on that as well. See, the IRS, they got a lot of ways in which to collect money, and that's just one of the additional ways that they can collect money from you. Number 7, or whatever number we're at, it's 7 in my notes, the year-end tax planning strategy is a very good strategy to have. And so what you need to do as we're getting to the end of the year is you really need to take some time in November and December to really look at where you are on your tax picture. Do you have a bunch of gains? Do you have a bunch of losses? All of those kinds of things are going to flow into your taxes. And understand that anything that you do in 2021 is not going to help you in 2020. So the notion of year-end tax planning is to make sure that you're looking at the year 2020 and ultimately making decisions based upon what your tax picture looks like. That's the notion of year-end tax planning. And you got to do it in the same year. Can't wait till next year, because that's then a new year. That's a different tax year. And then lastly, beware the paperwork, because what you're going to get if you're buying and selling stock on a regular basis, or just even one time, you're going to get something known as a 1099-B. Okay, that's a tax document that you've got to put on Schedule D, because all of those buy and sell transactions have got to be reported on an individual basis, because that tax document, 1099-B, that your trading platform location is producing, it's not only sending you a copy, but it sends the IRS a copy. So they know all about it. You've got to include it on there. And the reality is that that's a different schedule. There's a lot of details on that schedule that you have to include. That also means that more likely than not, your tax preparation fee is also going to go up. So those are just some of the things to be thinking about when it comes to taxes, and particularly for new investors that may be new and not realize some of the tax implications of what it is that they're doing. Rest assured though, the IRS does care, and they want to see that on your tax return. So we'll slide to a break, and then up next we're going to talk about the 3 very different problems that retirees of today face that are different than retirees of prior generations. All that and more coming up here on Dollars and Cents with Joel Garris here on News Radio WFLA Orlando 96.9 The Game. So today's retirees face 3 very unique problems that prior generations of retirees really didn't face, and those problems have really only gotten exacerbated as a result of COVID even. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris of Nelson Financial Planning. I'm a certified financial planner, certified financial fiduciary. Our team of certified financial fiduciaries at Nelson Financial Planning stands ready this very week to help you change your life with a successful financial plan that provides you with peace of mind for the future. So today's world obviously very different than prior days, and certainly COVID has accelerated a lot of those changes. And if you think of, back in the day where we used to all have 8-tracks and fax machines, although fax machines are still around, but you don't really use fax machines much anymore. Just like you don't use payphones. The more things change, right? In some cases, things have gotten easier, but in some cases, things have gotten more difficult. Certainly the flood of information I think that we get now that we didn't get in prior days can be very confusing. I think the amount of scams that are out there are much more sophisticated than they were in the past. We certainly talked about that on our last program in terms of some of the scams that are out there that folks need to be aware of. They're also similarly for retirement planning and getting income in retirement. I think there are 3 very unique set of circumstances that retirees face today that weren't really a problem of their predecessors. And in a lot of respects, COVID has accelerated that as well. And so really sort of number 1 on the list, chief among them, is this notion of low interest rates. And when you think about interest rates control sort of the safe side of the investing world, right? So how much you get on your money market, your CD, your savings account, that's your ultra safe stuff. All of that is determined by what the prevailing climate is for interest rates. Similarly, the bond side of your portfolio, which is the more conservative side, particularly in contrast to stocks, bonds pay interest. That interest, again, determined by the prevailing interest rate environment. So when interest rates are low, that's a situation where you've really got to be thinking about how much ultimately you need to generate the same level of income. So if you think of it in terms of, hey, I need $20,000 of income, right? So $20,000 of income, if it was 30 years ago, you could get 8% in a CD. And if you needed $20,000 of income in on an annual basis in retirement, well, then all you would need is $250,000, right? So $250,000, 8%, fantastic. Fast forward to today, and if you're lucky, you can find a 2% CD. And that means that in order to get that same $20,000, you don't need $250,000, you need $1 million. That's 4 times more than what you needed 30 years ago when interest rates were much higher. So the low interest rates really do have a significant impact on the safe side, the conservative side, the bond side of your portfolio. So as a retiree, what can you do about that? And we think that it requires you to really rethink your investment allocation, your asset allocation. The amount that you have in stocks, bonds, and cash can't be the same percentages as what one would typically have used 30 years ago, because 2 of those 3, the bonds and cash side, are at incredibly low numbers that in essence would force you to have to save a whole lot more in order to generate out the same level of income. So our advice is look at that percentage that you've got stocks, bonds, cash, and really look at maybe trying to adjust it in light of the current interest rate environment. And what that means is that you're probably going to have more on the stock side than what you might otherwise have to have had. So if you're having a larger portion on the stock side, you need to be much more selective in terms of what stocks to own. Our general advice on that would be, look, own the stuff that produces the stuff, the products, the services, the goods that the world uses every day. So that's generally name brand, large companies, preferably that pay a dividend. So that's risk number 1, that is unique to the current circumstances in terms of where the interest rates are. Number 2, and this one kind of cuts both ways, number 2 is low tax rates. Now, you may think, well, wait a minute, if the tax rates are low, that's fantastic, right? I mean, I'm going to be able to retire, I'm going to pay less in taxes. Well, here's the problem, and here's where COVID has come in to perhaps accelerate that. The risk going forward, we're at tax rates that are at 100-year lows in this country. So the risk going forward is not that taxes are going to stay low and go lower. It's probably the other way. And that's something that COVID has certainly accelerated. If you look at how much the folks in Washington have sort of put into the economy to try and sort of ease things for the American economy, as a result of COVID, you could have the amount of debt that this country owns relative to GDP be upwards of 130 to 140% of GDP. That's never good when you're over 100%. A year ago, that number was about 100%, meaning our debt as a country relative to GDP was about 1 to 1, 100%. We owed as much as our annual GDP. Unfortunately, now we owe about 30 to 40% more than what our annual GDP is. So what's the solution on that? The reality is that the last time you saw the debt getting so much outsized versus the GDP, it was in the immediate aftermath of World War II. What happened then? They raised taxes. Now, obviously, a whole lot of years later, taxes are lower, but the problem when you're at historical lows is that they're probably going up. So low taxes, which may be a good thing, at least at first blush. We think that could potentially be a bad thing and a very unique problem for retirees today that prior generations did not have to deal with. So the bottom line on that is, how do you deal with that? You've got to really be thinking about your assets in terms of their tax nature and really plan out your income in retirement. Really look at, I've got this asset here, that asset there, this asset over here. What's the tax nature of each one of these? It's going to be unique depending upon what it is. And think about your income in terms of where it's going to come from and what the tax implications are. And at the end of the day, you really got to do an actual tax projection on it. Not a back of the envelope kind of thing, but really have an official tax projection run on a tax return in order to really find out exactly where you're going to fall in terms of the tax side of things. So that's number two. Number three is the one that is continuing to compound itself, and that is the longevity risk, right? The risk that we're all living longer based upon advances in medicine and everybody knowing that how to keep better care of themselves, right? Don't smoke and things like exercise and eat better and all of that stuff that we know now that we didn't necessarily know 30, 40 years ago. And of them, longevity is probably one of the sneakier ones that has a significant impact on it because it has the effect of being a multiplier, right? The longer you live, the greater the problem is going to be if interest rates are low. The greater the problem is going to be if taxes go up. Longevity has a multiplier effect that the more you're navigating the proper investment mix and the more years that you have to eat for inflation to eat away and the more years to have to pay for medical expenses, that can significantly have a pretty sizable impact on your retirement. If you think of just medical, it's estimated that 70% of people that are age 65 or older are going to need some long-term care. Look at the cost of an average private room for a year in a long-term care facility, and it's north of $100,000. That's a big aspect of where that longevity risk comes in to play. So bottom line on that, understand that times are unique, and times are particularly unique if you are retiring. You've got incredibly low interest rates, historically low interest rates, historically low tax rates, and you also have a longevity risk as well. So certainly need to make sure that you are saving money more than what you might have in the past, and certainly make sure that you stay invested more on the equity side in order to try and reduce down or increase what your potential return would be over time. Bottom line, as with everything, have to plan ahead and make sure that you are prepared because it's unique, and it's a unique situation that retirees find themselves in today that's different than prior generations. We're going to take a break. When we come back, we will continue the conversation here on Dollars and Cents on News Radio WFLA Orlando.